So this video will focus on personal finance. Personal finance in economics looks at the various elements of saving and investing, financial intermediaries, insurance, and other topics related to your own personal budgeting and preparation for the future. So the first thing we're going to talk about is what an incentive is. An incentive is something that motivates you to do something or to not do something. So an incentive can be both positive and negative. In other words, there may be a policy or something in place that creates an incentive for you to behave a certain way. For instance, why would the United States government place such a high tax on cigarettes and other things that they deem to be bad for you? Well, the reason is they're going to try and create a disincentive to produce cigarettes. So this would be called a negative incentive. A positive incentive would be something that offers a benefit for a certain action. For instance, tax breaks for education purposes. If you go to school or higher education, the government allows you to write that off on your taxes. Again, these are incentives, both positive and negative, to try to create a certain pattern of behavior from a group of people. Now, one of the things we should be familiar with is what is called the decision-making grid. A decision-making grid or cost-benefit analysis allows us to determine the best course of action when making decisions. For instance, in this example, we have going to college or getting a job right after high school. There'll be 4 criteria for whether we should make this decision or not. If we go to college, there will not be immediate financial benefits. If we get a job, there will be. However, if we look at long-term financial benefits, college, based on historical analysis, will exceed the financial benefits of going directly into the labor force. Human capital is our ability to attain certain skills, abilities, and things that make us more marketable in the economy. In a very general way, going to college will increase that human capital, whereas getting a job may not allow us to meet our full potential in human capital. So if I go to college or university, most likely I will be obtaining certain skill sets that will allow me to be more marketable as an employee. If I go directly into the labor force, while I may increase my human capital, it may not be to the same potential than if I went to a higher education. Going to college is generally showed to have a higher standard of living relative to going straight into the labor force without a differentiated skill set. So what I would do based on my grid above is to count up the yeses and determine what I should do. And based on our simple analysis, going to college would be the best decision. Another important part of personal finance is to establish a budget. A budget is simply a way for us to determine how much money we have and how much money we're going to spend to purchase the things that I want and need. So in this example, we have an individual, it looks like they have 2 jobs, and this nets them just over $2,000 per month. Then we calculate all of their expenses, from a mortgage to car payments to health insurance, etc., and their total is $1,260. So when we take $2,060, that's their total net income, and subtract their expenses, we can see that this person has a surplus of $800 left over.
Therefore, a budget is an effective way of determining total income and total expenses.
A really important concept to understand in personal finance is that of a financial intermediary. There are many examples of financial intermediaries, but effectively, a financial intermediary is an establishment that channels money from people that save to people that want to borrow or invest. So let's take a look at how this works. Let's suppose that an individual has money that they want to put into their bank account. Well, the very purpose of this bank account is to create a way for this individual to store the value of this currency. But the question is, what is the bank going to do with this money? Their job, the bank, is to make money. And how does the bank make money? Well, they make loans. So they may make a loan to someone that wants to purchase a house or a car or a big ticket item like a TV. Regardless, what the bank is going to do, pay this individual a certain percentage, let's just say 6%, while charging the individuals that they made the loans to a higher rate of interest. Now, the real rate of interest that this bank earns is the difference between the amount charged and the amount that they pay. So if they're charging 13 and they're paying this person 6, then there's a real profit of 7%. And this is what we refer to as the spread. So the bank is going to charge the individuals a higher rate than they will pay to the individual that is putting the money in the bank account. So as we said a moment ago, banks are a traditional and classic example of an intermediary. Other intermediaries exist, such as credit unions. Credit unions offer sometimes lower interest rates on loans or borrowed money and higher interest rates on saving because they have an exclusive membership with their clientele. So this may be a teachers credit union or the naval credit union. At some rate, they are going to offer better rates for their members. Payday loan companies are another example of a financial intermediary that provides small loans at very high interest rates. And if you're going to receive a payday loan from one of these companies, you're going to receive your paycheck in advance and oftentimes pay a very high interest rate. So a payday loan is different than a bank or a credit union in that they are offering short loans on the value of a future payment, which is going to be in very high interest rates. A title pawn lender is an establishment that is going to use a certain physical item as collateral, usually a car or a motorcycle. And what they're going to do is say, hey, we will make this loan to you so long as you pay us back. And if you do not pay us back, then we have something of yours in value as collateral. And so this title pawn lender is going to take the title of your automobile, if you don't pay them back, at a very high rate of interest. So the important thing to remember again is that largely financial intermediaries are by design a way for savers and borrowers or investors to link up. And the more saving there is, the more access to borrowing there is. When you put your money in your checking account or your savings account, by and large, the bank is loaning the majority of that money. Now, when we talk about the difference between risk and return, what we're talking about is the relationship between a financial investment and potential expected return. So risk is the potential to lose money, while return is the potential to gain money. We should understand that there's a relationship between risk and return. That is, the higher the risk, the higher the return. The lower the risk, the lower the return. Now what we're going to do is take a look at the various investment options. So we'll talk about savings accounts, certificates of deposits or CDs, retirement accounts, U.S. Treasury bonds, mutual funds, and stocks. A saving account is an interest-bearing account at the bank. A CD is generally a time account, meaning that it lasts for a certain amount of time. Your money is inaccessible or illiquid during that period of time. And it may range from 1 month to 10 years. But the longer that you have your money in the CD, the higher the rate of interest to compensate for that risk. Retirement accounts vary from pension funds to IRAs to 401ks. But in general, a retirement account is something that you may not touch until you have reached a certain age of retirement. A treasury bond is essentially a loan, and mutual funds are generally a safer investment because they diversify in many different financial assets. A stock is a part ownership in a company, which you are investing in an individual company and an individual stock. So if I buy a portion of Disney, a stock of Disney, then I am part owner. While it may be a small part, I am still part owner. Now let's identify the risk and return behind these different accounts. So for instance, a savings account is going to be very low risk. A CD, because it is considered guaranteed interest from the bank, is also considered low risk. Retirement accounts can be either low or high risk, and this most certainly depends on when you decide to retire. If you were going to retire in 2008 and 2009, the net value of your retirement might have fallen exponentially. U.S. Treasury bonds are generally considered to be low risk because they are loans to the government, and the government is usually considered to be a safe bet. Mutual funds are also considered low risk because they invest in a diverse amount of financial instruments or financial assets. Stocks tend to be high risk. Savings accounts are going to net low return. CDs are going to generally net low return in 2019 anyway. Retirement accounts can vary. Currently, U.S. Treasury bonds are also somewhat low returns, and mutual funds tend to be higher returns than your traditional savings accounts or CDs. So again, just to explain each one of these, a savings account is a very risk-free place to put your money because the federal government will insure it up to $250,000. The specific agency is called the Federal Deposit Insurance Corporation. A CD is guaranteed interest with a bank, but again, it is non-liquid. Therefore, you cannot gain access to it until that has reached its maturity. Same thing with retirement accounts and bonds. Mutual funds tend to have a higher rate of interest in return. So the average interest rate return on a mutual fund is right around 8%. Stocks have a big potential for return, but also a potential for loss. So to sum it up, these are all the various investment options that we can look at in a general way for economics.
Now, one of the concepts in personal finance are the three types of tax structures.
There's what's called a progressive tax system, a regressive tax system, and a proportional tax system. A progressive tax system is such that the more you make, the more they take. In other words, as your income increases, so do your taxes. A regressive tax is effectively a tax structure where the more money you make, the less the tax affects you as a percentage of your income. So if you have a really wealthy individual and a low-income person, and they're both paying the same amount of sales tax on a particular purchase, well, that sales tax is going to be regressively more expensive for the low-income person than it is for the high-income person. A proportional tax is one that stays the same or is flat as a percentage of income. So everybody pays a particular percentage. Again, an example of a progressive tax in the United States would be the income tax. A regressive tax would be the sales tax, and a proportional tax would be something like a flat tax, which only states have in the United States and not the federal government. When an individual goes to borrow money, the creditor or the person that's going to be loaning the money wants to know if this person has credit worthiness. The way that they establish this is through what are called the 3 C's: character, capacity, and collateral. Character. Have you paid your bills? If you've paid your bills and paid them on time, you generally show good character. Capacity. Do you have a good job? Do you make enough money to pay this loan back? And if I'm going to buy a big ticket item, such as a car or a house, then the bank wants to know, can I pay these things back? Additionally, do you have any valuable assets or something that the bank could take as collateral if you don't pay back this big ticket loan? So again, the 3 C's are generally the way that the bank determines credit worthiness. Let's talk a little bit about what credit is. Credit is basically money that is loaned or money that is accessible for borrowing. And the way that banks determine if you are eligible for credit is based upon your 3 C's, but it's also based on your credit score. Now, your credit score can be found on your credit report, a report that provides a detailed analysis of your credit, meaning have you paid back your bills, what's your payment history, how much do you currently own, what amount of time have you been borrowing money, what type of credit do you have, and have you established new credit. And the 3 agencies that report this are Equifax, TransUnion, and Experian. They're called the credit bureaus. Banks are going to rely upon these credit bureaus to establish a credit score, and that credit score will be translated as either poor, fair, good, very good, or exceptional. Now, what we should establish is that the higher your credit score, the lower the interest rates you'll pay. The lower your credit score, the higher the interest rates you're going to pay. So there's an inverse relationship between your credit score and the interest rates you'll pay, and additionally, if you will or will not receive the loan. So a credit score is a reflection of your ability to receive the loan and your credit worthiness. A couple of terms that you should know about borrowing are APR, fixed rate, and variable rate. APR stands for annual percentage rate. It is the interest rate and any applicable fees involved in any kind of a loan. Now, obviously, you're looking for low interest rates. When borrowing will mean that you're paying back less to your creditor. So a low APR is indicative of a low interest rate and low fees from your creditor. Rates can either be fixed or variable. A fixed interest rate will not change during the duration of the loan. So if you have a 30-year mortgage with a fixed rate, your interest rate will remain the same for 30 years. If you have a variable interest rate, that means that your interest rate can adjust based on current market conditions. You can see in this table that you have 3 institutions, institution A, B, and C, and each of them offer a different rate. So if I'm looking at a mortgage and I'm looking for my lowest APR, it appears that institution A has the best mortgage rate. If I'm looking at borrowing for a car, it appears that institution B offers the best APR. A home equity loan would be a loan borrowed off the value of your home, and again, institution B seems to have a lower interest rate on that. Looking at the credit cards, it appears that the lowest APR range would be, again, with Bank B. So comparing these interest rates can help me to determine whether or not to take a loan with institution A, B, or C. Another important concept in saving and investing is simple interest and compounding interest. Now, simple interest is interest that gains interest on principal alone, while compounding interest is interest on principal and any accumulated interest during the duration of the loan. So compounding interest is certainly preferable if you are saving money or investing. Therefore, compounding interest will gain more in the long run, as you can see in this table here at the bottom. In this table, simple interest is rising at a rate of $10 a year, whereas compounding interest is rising based on the principal investment in addition to any gained interest, which creates exponential growth. Now let's talk a little bit about insurance. Insurance is a way for you to mitigate risk. It is the old adage, safety in numbers. So what we're going to do with insurance is we're going to pool our money, and we are going to allow this pool to pay for any unexpected scenarios that we might encounter. For instance, if we have a pool of people that have put money into automobile insurance, then we are trying to hedge against the possibility of an accident. Health insurance is insurance that pays for you if you get sick, or if there are maybe situations like having a child or wellness checks. Life insurance is designed to pay for things that, let's say, a spouse was expecting their husband or wife to pay for during the course of their life. Maybe like a house payment, car payment, education for children. Disability pays for someone if they are unable to work. So if somebody goes extended period of time, let's say with cancer or some other ailment, disability is going to pay for that person's salary, or usually a percentage of that person's salary during that period of time. There's both short-term and long-term disability. Property insurance is designed to insure your home against damage to your home. You can also buy property insurance on things like jewelry. So if you have jewelry that is stolen or lost, property insurance will pay for that. A few more terms to understand for insurance are deductible. Deductible is the amount you pay in the event of an accident. So for instance, if you get a car accident and it costs $1,000, you will have to come out of pocket for your deductible. Most people elect to pick like a $500 deductible. So you would pay the $500, then the insurance company would pay the balance of $500. The premium is the total amount that you would pay for coverage. So for instance, you might have a 6-month premium with a very low deductible. Well, that's going to be more expensive for you to be covered. If you pick a higher deductible plan, then your insurance will go down or your premium will go down. So your premium is what you're paying to be covered. When you're insured, you are in a shared liability situation. So the insurance company is sharing your liability. They are essentially picking up you as a partner. Other examples of shared liability might be marriage or a partnership in a business where you are coming together and now you are considered liable for one another's action. Sometimes people elect to insure themselves through asset protection. So they might put their house or some other asset in another person's name, and that will protect them if they were ever sued or they were liable for something. Another important thing when we talk about personal finance is to consider what leads to success in the workplace. So it's important to have good communication, to be punctual, and to be self-motivated. Good communication. Communicate with the person that you're trying to get your ideas across with. Be on time, be punctual. And finally, have intrinsic motivation. Be motivated to succeed outside of just things like money. It's important for us to understand the things that make us successful in a market-based economy properly to set ourselves up for the future. Well, that's personal finance in the personal finance section of economics.